a Bonica researcher, the researcher in USC. I'm going to get USC Onja USA reboot. So today we are doing a deep dive into something that honestly feels like a complete paradox when you first look at it.
Yeah, it really does.
Right. Because, if you look at the United States right now, they are sitting on this just staggering $39 trillion in national debt. But then, and this is the crazy part, you look at the markets.
The markets are totally disconnected from that reality.
Exactly. The S&P 500 is like hovering near 7,100. Bitcoin has been smashing past $125,000. It's wild. So our mission today for everyone listening is to decode this. How does a country that is basically drowning in unprecedented debt simultaneously produce all-time high financial markets?
Well, it looks like a complete contradiction on paper, right? I mean, you're looking at a system under massive structural stress. It's a government balance sheet that, frankly, defies basic arithmetic at this point.
Yeah, the math just doesn't math.
Exactly. But then, you look at your 401k, your brokerage account, and everything looks fantastic. So to make sense of it, you really have to look beneath the surface noise. You have to understand the actual mechanical playbook the government is using to manage a debt load they just can't afford to pay off normally.
Right, because if you're a beginner trying to read the financial news right now, it feels like you're living in two completely parallel universes. You have pundits screaming about an impending debt crisis on one channel, and then stockbrokers literally popping champagne on the other. So let's decode the playbook. Let's look straight at that $39 trillion elephant in the room. What is the actual math here?
So the math is sobering, to say the least. By late April 2026, the debt held by the public is roughly 101% of the U.S. gross domestic product.
Wow.
Yeah, so that means the debt is officially larger than the entire economic output of the country for a whole year.
That's just hard to wrap your head around.
It is. But the real pressure point isn't just the principal amount. It's the cost to carry it, right?
Okay.
The interest payments alone are now running over $1 trillion a year.
Wait, $1 trillion just in interest?
Just to service the debt, yeah. Not to shrink it at all, just to tread water. And the Congressional Budget Office is projecting that by 2056, this debt could reach 175% of GDP.
Oh my gosh.
We are on a trajectory where the compounding interest essentially becomes like an event horizon. You just can't escape it.
But wait, if we're paying $1 trillion just to service the interest, that math simply doesn't work long term. I mean, you can't just tax your way out of that hole without utterly crushing the broader economy, right?
No, you can't.
And you certainly can't, cut $1 trillion in social programs without causing absolute political chaos.
Exactly. Which is why neither of those honest, straightforward solutions are actually on the table. No administration is going to commit political suicide by, doubling taxes on the middle class or slashing essential services to the bone.
So what do?
They rely on a much quieter, highly effective mechanism. It's known as financial repression.
Okay, let's translate financial repression for anyone new to this concept, because it sounds intense.
It's basically a stealth tax.
Right, so it sounds like keeping interest rates artificially capped while letting inflation run a bit hot, right? So it's like borrowing $100 from someone, but by the time you pay it back 5 years later, inflation has run so high that the $100 only buys a sandwich.
That's a perfect analogy, yeah.
So the lender, meaning, anyone holding U.S. dollars or U.S. bonds, secretly pays the price through lost purchasing power.
Yes, exactly. And to build on that, the government repays the exact face value of what they owe. So they fulfill their technical obligation, but the intrinsic value of that money has just evaporated.
Wow.
It slowly and reliably melts away the real weight of the national debt over time. But the flip side of that equation is that it also melts away the purchasing power of everyday citizen savings.
Right, because if your savings account yields 4%, but real inflation is subtly running at 6 or 7%, you're actually losing money.
Exactly. Your wealth is being repressed to subsidize the sovereign debt.
Okay, but if the government is deliberately melting the value of the dollar to escape their debt trap, the massive global investors holding that debt have to be fully aware of it.
Oh, they are very aware.
I mean, someone like China, for instance, isn't going to just sit on their hands and let hundreds of billions of their national reserves turn into sandwich money. They have to be panicking.
Well, they are aware, but sovereign nations of that size, they don't panic, they calculate.
Okay.
And we are seeing a massive, highly pragmatic withdrawal from U.S. debt. By February 2026, China actually dropped their U.S. Treasury holdings down to $693.3 billion.
Wait, down to 693 billion. What was it before?
Well, to put it into perspective, they have methodically cut their positions by over 47% since their peak holding back in 2013.
Almost half.
Yeah, almost half. For 9 straight months in 2025, they were net sellers of U.S. debt.
See, that's wild because the media often frames that as a geopolitical attack. You constantly hear this narrative that China is like dumping U.S. debt to intentionally destabilize the dollar and wage economic warfare.
Right, that's a popular headline, but the reality of the mechanics is much colder and much less emotional.
How so?
Well, if China were to aggressively dump $600 billion in treasuries onto the open market in a single week, bond prices would absolutely crash.
Right.
And because China still holds a massive amount of those bonds, they would essentially be destroying their own net worth.
Oh, that makes sense. They'd be shooting themselves in the foot.
Exactly. So instead, it's a slow surgical bleed. They simply let their existing bonds mature, they take the cash, and they intentionally choose not to reinvest it back into U.S. debt.
They're just quietly walking away.
Yes. They are looking at the exact same structural instability we just discussed, the endless deficits, the trillion-dollar interest payments, and they are quietly heading for the exits.
That raises a massive question, though. If China's pulling billions out of U.S. debt, where are they putting it? They can't just shove it under a giant digital mattress.
No, they can't. They are diversifying into alternative physical assets, primarily gold.
Okay, gold.
Yeah, this is a major factor driving gold to historic highs, hitting around $5,589 an ounce in early 2026.
Wow, over 5,500.
Yeah. They are moving out of paper promises that are being actively debased and into historically secure physical reserves.
So we have gold hitting almost $5,600 and oil is spiking up to, what, $120?
Roughly, yes.
But simultaneously, crypto and equities are hitting record highs. It's this bizarre paradox, right? You have retail and institutional investors aggressively buying crypto and tech stocks because they want high returns, the classic risk-on trade.
Right.
But at the exact same time, they are hedging their bets with record-price gold. It's like everyone's at the casino playing at the highest risk tables, but they were all wearing life jackets.
That is exactly it. The life jacket behavior is the key to understanding the psychology of the market right now. There is just a massive amount of excess liquidity sloshing around the financial system looking for a home.
Huh.
But underneath that liquidity is a profound structural fear of debasement. Investors know the currency is melting, so they are throwing money into any asset that might outpace inflation, whether that's an AI stock, a Bitcoin, or an ounce of gold.
But this brings us to a mechanical contradiction that I'm really struggling with.
Okay, what is it?
If China is quietly bleeding out of the bond market, and the debt is this massive unpayable anchor dragging on the economy, why are stocks at all-time highs? Like the S&P 500 sitting up above 7,100 makes absolutely no sense if the foundational asset of the global economy, U.S. debt, is bleeding trust.
Right, and this is where we get into the actual plumbing of the financial markets. The stock market is breaking records largely because the debt apparatus itself is artificially propping it up.
Wait, how does the national debt prop up the stock market? Walk me through those mechanics.
Okay, so the government is running a massive deficit, meaning they spend far more than they collect in taxes, right? To cover that spread, the Treasury has to issue new debt. But the Treasury has also been actively managing the liquidity of the bond market through buybacks.
Buybacks, like corporate stock buybacks.
Similar concept, but for government bonds. Since 2024, they have executed an estimated $270 to over $300 billion in Treasury buybacks. They purchase older, less liquid government debt from the primary dealers and replace it with fresh cash.
So the Treasury is essentially stepping into the market as a buyer of its own debt to keep the gears turning and prevent the bond market from freezing up.
Exactly.
But how does that jump from the bond market over to my personal stock portfolio?
Because that fresh cash injected into the financial system doesn't just sit idle. The banks and the dealers, they take that newly acquired liquidity and deploy it wherever they can get a yield.
Oh, I see.
Estimates show that roughly 15 to 20% of the government's deficit funding indirectly bleeds right into the equity markets. Add to that the fact that corporations within the S&P 500 are forecasting a record $422 billion in their own stock buybacks for 2026.
Okay, let me make sure I'm synthesizing this correctly for everyone listening.
Go for it.
When I look at my portfolio and see record highs, my takeaway shouldn't be, wow, the underlying economy is fundamentally booming with incredible new manufacturing and unprecedented middle-class wealth.
Unfortunately, no.
My takeaway should be, Wow, government debt liquidity is overflowing its banks and flooding into equities. The market is basically addicted to this artificial localized pump.
That's a great way to phrase it. And it creates an incredibly dangerous dependency. The market is rising on the back of constant liquidity injections rather than, organic fundamental economic strength.
That sounds terrifying long term.
It is. And the government is acutely aware that you can't run an economy on a localized liquidity pump forever. Eventually, either the inflation breaks the consumer or the interest on the debt breaks the budget. They know financial repression and stock market illusions have an expiration date.
So they must be building a permanent off-ramp then. Which brings us to this concept from the sources of the American reboot.
Yes, exactly.
If the old system of relying on foreign nations like China to buy our debt is dying, what are they replacing it with?
They are executing a massive, highly technical digital infrastructure upgrade. And it really comes down to two primary components: the rollout of ISO 2022 and the legislative framework of the Clarity Act.
Okay, let's take those one at a time. I hear ISO 2022 mentioned in financial circles a lot, but to the average person, it just sounds like an obscure software update.
Yeah.
What is it mechanically?
So for decades, global banks have communicated and sent money using older, clunky messaging systems. Think of the old SWIFT formats.
Right.
They are slow, they carry very little data, and they are prone to delays. ISO 2022 is the new, globally mandated messaging standard.
Okay, so a messaging upgrade.
Exactly. And by November 16th, 2026, the major U.S. payment systems, so that's Fedwire, HPS, and SWIFT, they will be fully synced to this standard. It brings incredible speed, rich data transparency, and crucially, technical compatibility with blockchain networks.
Oh, wow. So they are systematically ripping out the old banking dirt roads and laying down high-speed fiber optic cables.
That's a great visual, yes.
It's not just about making a bank transfer faster. It's about making traditional fiat dollars and digital blockchain tokens natively fluent in the exact same language.
Precisely. ISO 2022 provides the rails. But to move trillions of dollars of national debt onto those rails, you need concrete rules for the trains, so to speak.
Right.
That is where the Digital Asset Market Clarity Act of 2025 comes in. The Clarity Act passed the House and moved into the Senate to solve the regulatory turf war in the U.S.
Because right now, the SEC and the CFTC are constantly fighting over who gets to regulate crypto.
Exactly. It's been a mess.
So how does the Clarity Act actually resolve that?
It introduces a concept called the mature blockchain test. If a digital asset or token is sufficiently decentralized, meaning no single small group of developers controls its core functions, it passes the test.
All right.
Once it passes, it moves away from the strict, often cumbersome securities regulations of the SEC and gets classified as a digital commodity under the CFTC.
But why is the federal government suddenly so highly motivated to create clear blockchain rules? I mean, it's not because they suddenly fell in love with Bitcoin.
No, definitely not. It's because they need to tokenize real-world assets. Specifically, they want to create tokenized U.S. treasuries.
Ah, there it is.
Yeah. The Clarity Act provides the exact legal framework required to take that $39 trillion in heavy analog government debt and represent it as digital tokens on a blockchain.
That's huge.
It is. It allows for what the industry calls T0 settlement instantaneous, 247 clearing of debt trades, rather than waiting days for traditional clearinghouses to settle the paperwork.
But hold on a second. This is where I have to push back a bit.
Okay, go ahead.
We just spent the first half of this deep dive establishing that the U.S. is actively melting the value of the dollar through financial repression to escape their debt, right? So who actually trusts a tokenized treasury if the underlying currency is being debased? Aren't we just putting a melting ice cube on a faster, shinier fiber optic cable?
That is a very valid critique. The intrinsic value of the debt doesn't change just because it's digital.
Exactly.
However, what does change is the friction, the accessibility, and the utility. When you put a treasury on a blockchain with T0 settlement, it can be used instantaneously as collateral in decentralized finance.
Oh, I see.
It can be traded at 3 a.m. on a Sunday. It creates a level of global liquidity that simply doesn't exist in the legacy bond market.
Okay, so they've built the high-speed fiber optic roads with ISO 2022. They've written the legal traffic laws with the Clarity Act to tokenize their debt. But the big question remains, if sovereign nations like China are stepping back, who actually steps in to buy billions of dollars of digital U.S. debt?
The answer is sitting right now in the crypto wallets of millions of everyday people around the world.
Wait, what do you mean?
The secret funding mechanism replacing foreign sovereign demand is the stablecoin market.
Seriously? Stablecoins?
Yes.
Wait, Tether has roughly like $189 billion in circulation right now. When a user in Argentina or Turkey buys a digital Tether token to escape their local hyperinflation, they hand over real U.S. dollars to Tether.
Correct.
But Tether can't just be sitting on $189 billion in cash in a giant digital mattress. They must be yielding a return on it, or the entire business model makes no sense. So what are they actually doing with that capital?
They invest it directly into the safest, most liquid asset on Earth, short-term U.S. government debt.
Oh my gosh.
Yeah, the data from spring 2026 shows that the total stablecoin market is over $320 billion. The major issuers put between 80 to 85% of their real dollar reserves directly into Treasury bills.
That is insane.
Tether alone holds $122 billion directly in U.S. Treasuries.
This is staggering. Instead of the Federal Reserve having to politically print money to buy the government's debt, which makes the public furious about inflation, millions of random individuals around the world buying crypto to make payments or hedge local inflation are accidentally funding the United States government deficit.
Exactly. It is the private monetization of debt on a global scale, and it is a brilliant, quiet, structural shift.
It really is.
It completely bypasses the traditional political headaches of quantitative easing. The U.S. Treasury secures a massive, politically agnostic, and highly stable source of demand for its debt.
Wow.
And in return, the stablecoin companies make billions in yield. I mean, Tether made over $10 billion in 2025, largely just from harvesting the interest on those government treasuries.
It is deeply ironic that crypto, an industry born out of a desire to bypass central banking and government fiat, has effectively become the primary funding mechanism keeping the U.S. deficit afloat.
It is the ultimate pragmatic marriage of convenience. The government gets their debt funded, and the digital economy gets a stable, dollar-pegged base layer.
So if we pull back and synthesize this entire roadmap for the beginner investor listening today, the United States is managing an otherwise unpayable $39 trillion burden through a three-part survival strategy.
Right. Let's recap.
First, financial repression, keeping interest rates below inflation to quietly melt the real value of the debt over time.
Yes.
Second, an artificial stock market illusion, where Treasury buybacks inject liquidity that bleeds into the S&P 500 to keep the financial surface looking strong.
Yeah.
And third, this massive digital reboot, laying down the ISO 2022 Infrastructure and Clarity Act legal frameworks so that global crypto users secretly fund the deficit via stablecoins.
That captures the entire transition perfectly. And, for the investor trying to navigate this landscape, the absolute most important skill you can develop right now is the ability to differentiate between ordinary market noise and fundamental structural change.
Right. So how do you practically spot the difference when you're looking at the news?
Well, market noise is the euphoria. When you see stock buyback rallies pushing the S&P 500 to 7100 or short-term liquidity pumps making headlines, that is noise.
Okay.
It feels incredibly real and profitable in the moment, but it is built on temporary debt mechanics, not sustainable economic reality.
And the structural change.
Fundamental structural change is the underlying plumbing. It is the unglamorous rollout of ISO 2022. It is the legal reclassification of digital assets under the Clarity Act.
It's the boring stuff.
Exactly. The boring stuff is what matters.
Yeah.
It's the massive shift from relying on foreign countries to buy our bonds to relying on global digital stablecoin adoption to fund the deficit.
Yeah.
That infrastructure transition is the true American reboot.
Tracing all these mechanics brings us right back to that opening paradox. The X-ray of the economy looks fundamentally broken, carrying $39 trillion in heavy analog debt.
Yeah.
But the patient is still somehow running a marathon because they are completely rewiring their own nervous system to run on digital liquidity.
That's a great way to look at it.
Which leaves us with a final, slightly mind-bending thought for you to ponder today. If the U.S. successfully tokenizes its massive debt onto the blockchain, and it becomes the foundational backing for stablecoins used in every digital transaction globally, does the concept of a national default even exist anymore? Or does that unpayable debt just permanently morph into the base layer of the internet's money?
It creates a completely unprecedented economic paradigm. We're watching the definition of sovereign debt rewrite itself in real time.
We really are. Well, thank you for helping us decode the mechanics behind this incredibly complex landscape today.
Vårt medium och